What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are just kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
Today I'm joined with Peter May. How you doing today, Peter?
I'm doing great. Sorry for the really dressy roll, but it was one of those early mornings, dog barking in the background, etc.
That'll do it. And maybe the dog was barking because I got some great news for you, Peter. I don't know if you know this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate investors, syndicators, buyers, sellers, all that sort of thing. And you might ask yourself, why would you do that? Well, if you've ever heard of an off-market deal, sometimes they're called private, sometimes they're called 506B syndications, then you should know that you need documentation of your prior substantive relationship, or else the SEC will get ants in its pants, and we don't want that, do we? But before we get too far into commercial real estate, how the deals work, and how my guest fits into those deals, Peter, do you want to say a thing or two about yourself before we talk about your business?
Keep it very brief. Former or recovering CPA, tax attorney. I operate in the CFP space as a certified financial planner. I'm associated with a registered investment advisor called Alpha Star in the greater Charlotte area. And I have a business colleague, Ross Rubin, and our DBA is a thing called DST Sherpa, which is short for Guide You Through the Mountains, or more importantly, educate you so you don't fall into a crater or cavern or off the slope.
All right. I love it. I love it. Because after all, everybody has to know what's going on, and everybody is very motivated to do more in this business. But before I get to that first segment, I got to say, but wait, check your eight. Peter, I don't know if you've got that phone with the extra features where you can see through the camera and into the user's device somewhere down at your eight, but there might be this hideous subscribe button that they haven't hit. Okay, it's a silly joke for this generations. But anyway, the 5 distinct motivations. I've spoken to hundreds, maybe even thousands of investors at this point, and everybody has their own unique why. And it's really important for partners to understand what that why is, just because these deals take months to close, they take years to go full cycle. So we need to know what's actually going to keep somebody involved. And even though we have our own unique whys, I find they fit pretty neatly into these 5 different categories. The first one of which is preservation of purchasing power. What on earth is that? Well, if you already have a portfolio of assets and the way that you make ends meet is not from a W-2 full-time job or anything like that, then the way that you're paying your bills is through the proceeds of ownership. And if that's the case, if you don't need to work, why would you bother making another acquisition and going through all that hassle? Well, there are a few situations. One is if inflation is rearing its ugly head, it's eating away from the purchasing power of your cash flow, it's going to be time to make a new acquisition. The other situation is when there's sources of distress in the property, or there's an asset crash, and so as a result, you can buy at a steep discount, and then that way you can protect your purchasing power that way. I'm not to that phase of my life yet. Where I am is trading my time directly for wealth. And that's because I got a background in technology. Specifically, it's in the CRM industry, which is for mass marketing, mass emailing, and selling to hundreds or thousands or tens of thousands of people. Now, I got into real estate from this CRM agency tech background back in 2014, and I was working for a guy who was doing 10 single-family house transactions every single month. And when I found out how much more he was making than I was, and all of the different tax advantages that come along with it, it got my wheels turning, going, How do I pivot to make it where I'm getting rewarded in the form of deployed capital, aka equity? So that's why I'm doing this. And that's a little too subtle for some people, especially youngsters. A lot of youngsters, they're more attracted to commercial real estate because they want to hustle hard right now and then retire early. But some people, it's not so much about retirement as much as just taking control of their own schedule. Maybe that means working fewer months per year or fewer weeks per month, but that's some sort of like dialing back, scaling back down the road. And a lot of people who have this as their motivation, they think everybody's like that, but I assure you, it's not true. There are plenty of people that are fueled more by ambition and generational wealth, and that means they want to make sure their great grandchildren never have to hold a day job. So they're going to buy up their entire hometown. They're going to make sure that that they have more and more coming in, and they're going to keep hustling into their 90s, which is fantastic for any partnership. But the last group, they're also similarly more motivated to work into their 90s, and but they've, instead of working on their own legacy or their own name in lights or something like that, they've picked a sector of society. Maybe it's animals, maybe it's the environment, maybe they want to send people to space. Who knows? But if you want to have a really big impact, there's a financial component to that. And that's why some people are making their acquisitions and building their net worth. So, Peter, of those 5 different motivations, what combination of those would you say describes you best?
I would say first and foremost, help people who need it is where I anchor into because of my education. And the other is um, I should be paying people for how much fun I'm having. I mean, I just call it that. When somebody's like, I hang out and play tennis with a group of guys, some of them are in their 80s. Now I'm only in my first of 60s. It's not work. Now, you do have to work at it. You do have to make little money. You do have to pay the bills. But if you've got your house paid for, if you got your kids' education taken care of, you're okay. And people helped me along the way, and God gave me a brain. Unfortunately, he gave me 10 thumbs. So all that stuff with the real estate doesn't register, but how to play 3D chess does. And the 3D chess is, our 4 quadrants of taxes, cash flow, investment positioning, where is it, and estate preservation. So if I can help somebody down that path, then I'm in a better place.
I love it. I love it. But of course, it's nice to say all these wonderful things about real estate, but real estate is a business and businesses have risks involved. And if you've ever
Don't
been,
work for and I don't work for free. I say I work for a fee. So you
right.
take free, drop the R, and it's a fee. So just so everybody understands that I'm not completely altruistic.
Right, exactly. And then there's the fact that there are risks involved. And if you've ever been involved in a 506B deal, one thing that the securities attorney in the mix should have forced everybody to do, and if there is no securities attorney involved in your deal, then run, and hide. But if they force you to answer this questionnaire with lots of invasive questions about your finances. And me, because of my teaching background and building all these different wizards online, different quizzes and things like that, the one question about tolerance for risk, I felt it didn't give me an answer that I could actually use. So I made up my own one, which is a fill in the blanks question. And it is, there are many popular investment asset classes, but I think blank is too risky. So, Peter, your answer can be from inside real estate, it can be from outsider real estate, but what's too risky for you to invest in?
Something that I don't understand.
So you don't understand. So, are Pokemon cards in that category?
It's kind of, that's if you want to dabble in Bitcoin, and I'm
Right.
sure and dabble may not be a fair word, but then take 1 or 2% of your funds and use it for your sandbox.
Mm-hmm.
We will
Mm-hmm.
allocate in a client's portfolio a portion of it to sandbox. That's where you go play, that's where you go build, and you have fun, and you realize if you lose, you're not going to be punished because of it. So
Mm-hmm.
it's play money, for lack of a better word. So if
Mm-hmm.
you don't understand it and really don't have a passion to learn it, then I stay away from those because there's more fun to have in other places.
Yep, and it's gambling after all. So the next question I have is difficult for some of the newbies, but I should emphasize the fact that not everybody who's involved in a commercial real estate deal, not all of the partners are going to be fully fluent in every single metric that makes an underwriter's decision. But just so that you and the audience, if you are interacting with my guest Peter, I want to give you a chance to know what the headline metrics are that they focus on the most are. And for anybody who's only listening to this episode rather than watching, I'm going to read these all out. And Peter, hopefully you can give your top three or something like that. The metrics are cash on cash, IRR, cost per door, NOI, which is net operating income, the going in cap rate, and really that would be the difference between the region's standard cap rate versus what you're going in at, the interest rate of the loan, the occupancy of the property, the average income in the region where the property is located, the amortization period of the loan, the difference between the market and the in-place rents, the population growth where the property is located, the sponsor record, which includes how many deals have gone full cycle, how many deals are ongoing, the waterfall or split of the deal. So after the capital has been returned, what sort of ownership rights do you still have? And the last one I have is debt service coverage ratio. That's definitely not all of them. All of them matter. But Peter, what are the real headliners when you're looking at deals?
When we look at deals and try to whittle down from the world of this to the world of this, our first place is sponsor record.
Mm-hmm.
That's our first due diligence cut. And I use the world of DSTs. There may be 40 different sponsors out there, and they're all good, but we only deal with the top 6 to 8.
Mm-hmm.
We only want blue chip. We're not trying to grow wealth. We're trying to protect wealth. And so that one is the first. The second one would be probably the waterfall or the splits. Who's getting paid? How are they getting paid? When are they getting paid? Because for us, since we're an RIA, we don't take fees out of the front end. So if a client puts 100,000 into the deal, they actually start at 106,000. They get grossed up by what the commission would be internally, and then we take our annual fee based on assets under management. So those are the first two. The one that's not on there, but I'm sure you can help me fit it into one of those, is how do you get out of the deal?
Mm-hmm.
What's the exit strategy? At the end of the day, someone's going to pay you at a point in time an amount of money. And so what's the exit strategy? What do you own? How do you want it? Because in DST world, you can go from a hard property to a fractional ownership in a DST to what's called a 721 UPREIT, where you now exchange your DST for interest in a REITs, but you're out of the 1031 world. So I just want to know, where's the plane flying? How many stops are there? Do I have to change planes? And can I still have my cocktails?
I love that. I love that. Yeah, I think I should probably put an extra slash after split and write the word exit in there, just so that's, sort of baked in there, because a lot of waterfalls, they end up disappearing, and that's no good. But I love that answer. I'm eating it up like a wonderful subscribe sandwich. Doesn't that look satisfying right there? That it's not very subtle, but it's to remind me to bring out the Dan Does Deals Commercial Core Competency Cube, which has the 6 different roles in a commercial deal. And I go through all 6 sides in every episode because it's important that you not only understand how my guest fits into these deals, but also that you can learn to effectively communicate on the subject of commercial real estate deals. And if you want your own copy of this, the good news is it's completely free at dandoesdeals.com. There's a button you can just click on and download it and print it out, and you can practice using these different terms. And like a complete dummy, I committed the cardinal sin of marketing, which is I gave away my freebie without asking for any contact information. You should always ask for some sort of contact information in return for your freebie, but I want to make sure that this is as easy as possible. So let's go through this. It just takes a couple minutes. Repositioners are what a lot of people start out as being, and and they are acquisitions people. So their job is to go through a whole whack of paperwork, look at a whole whack of different deals to find the ones that they're actually going to pursue. And I call them repositioners because they're figuring out how can they change how the business is run to find more upside. And one of the sort of counterintuitive ways that they do it is they have a vast network of financiers. Financiers are people who only deal with paper, money, and the people who own that paper and money. So financiers are lenders in general, and that is why the repositioners have to have a vast network of them, because if you can secure a more advantageous loan, that goes straight to the profitability of the building. So that's why they have to meet a lot of financiers. But the next place the repositioner is going to look to find some upside after they've done all the underwriting, and just so you know, the underwriting is when they're doing the math to find out, is this property even making the amount of money that the seller or broker is claiming it is? Because so the repositioner has to have another play. So the next place they're going to look is in operations. They're going to figure out how to stop those Benjamins from going down the toilet. But of course, even if you're like me, personally, I focus on deals where it's 100 units or more. And that means they're often outsourcing to a third party property management company. And so that means the asset management role of the GP teams, they're a little bit different. Me personally, my web asset development, my mass marketing, and also the content creation pieces are big things that I do in asset management. If you understand that when it comes to commercial real estate, vacancy is the enemy, then you know that even if you are outsourcing, if your property management is having trouble filling the units, somebody on the GP team has to have some serious marketing chops. And so that's where I can come in. But of course, there's only so much you can do to find upside in operations and making them more efficient. So the next thing a repositioner is going to do is they're going to get a contractor team involved to upgrade the property, to make the units nicer, to make it so that you can charge more money to the future residents compared to the previous ones. But of course, it's all about return on investment. So you don't want those contractors gold plating any toilets because you're never going to get any money on it. And if you're like me, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground. I need people who can be there in an hour or two, because that will not be me. I'd still be stuck at an airport in an hour or two. So you really need to have somebody who can keep the contractors accountable so that they're not dragging their heels, they're not using subgrade materials and things like that. And the locals also keeping an eye on the operations, making sure the property managers aren't deceiving the ownership team. But when the repositioner, let's say you're the repositioner, let's say you're a physician or an attorney or an engineer or something like that, and you and your group of friends say, hey, let's take over that apartment complex that's just over there. It's 350 units and tens of millions of dollars. So you turn around to the financiers and say, hey, guys, you got, I don't know, tens of millions of dollars you want to lend us? Well, the part that I want to emphasize next is the flaw in your little hypothetical right there. And a lot of gurus and mentorship programs, they really gloss over this part. So I'd listen carefully. The financier, or in other words, the bank, is going to say, who's your KP? Who's your sponsor? What's that all about? Well, when you've discovered this 350 unit apartment complex that you want to take over with your pals, each putting in like 100K or something like that, somebody in the fold has to already own a similar asset, or else the bank will simply say that you're not eligible. And so that's why you have to have somebody like that involved. And on top of that, you need a certain amount of liquidity. And then among the ownership team, you need a balance sheet of at least the amount of the loan. But if you've got all those pieces, you got yourself a commercial real estate deal. So Peter, you've actually got all the licenses, by the sounds of it, to stick to being a financier and not be breaking the law like some people do, you know, publicly soliciting all willy-nilly and all that sort of stuff. So I think that's your main thing, because you're still doing your team's still doing underwriting as well, but it doesn't sound like you'd be as active in that. But I don't want to put words in your mouth. Which boxes do you check?
Probably would the big check mark would be on the financier standpoint. The small check marks are on the others, because as a planner, you're always looking for what can and will go wrong. It's kind of like mapping out somebody's estate. You know, we're looking at your will, Dan, and who's going to be power of attorney for you when the time comes? Who's going to be your healthcare directives when the time comes? Or the part that we always like to raise with clients is, your kids who are in their teens at some point will become 21, which are adults. They need to stay as your property, meaning power of attorney and healthcare directives, because if something happens, you no longer have power over them. Now, they don't want you to have power, but you want to mitigate risk where it exists. So I may not know about contractors, but I know that, like you said, getting to another part of the country is a pain in the rear. And so unless they can iPhone you and walk you through the property, it's knowing where the risks are and saying, okay, and the best way I think of it, I'll be quick with it, is I start out being the smartest person in the room because I have to be the man or gender or whatever. By the end, I don't want to be the smartest person in the room. So of those 6 slides, I want somebody who's the contractor, the repositioner. And I want to know that they've run that committee correctly. Think of it as a startup. So you have one area that you're really comfortable with. The other area is that you're smart enough to know what not to know. Does that answer your question?
Yes, it definitely does. And that brings us to the buy box, which that is more for when people have a deal in hand. But when different investors, syndicators, and whatnot are talking to each other and saying, hey, what you looking for? What's your buy box? What's easier to say yes to and more difficult to say no to? We're really asking about 3 main things. First one's geography. We got to know which state it's in. We got to know which county it's in. We probably need to know which neighborhood it's in. But regardless, that geography is going to matter. The second one's going to be size. Now, most of my guests on this show are in multifamily, which is apartment complex investing. There's plenty of other types of commercial real estate. Some of them go by square footage, but the size in multifamily, we define that by the unit count. And it's important because the type of group that is comfortable taking over 10 and 15 unit apartment complexes, they're going to look completely different from the 100, 150, and so on. So that size definitely matters. But the third one is usually called class. I prefer the term desirability because it's split into 2 parts. Those 2 parts are condition and area. So if you're talking about the condition, it's how old is the property and facilities that are on it? How beat up are the property and facilities on the site? And the other thing about condition is what about amenities? Are there lots of luxuries and amenities, or is it really a no-frills sort of location? So that's the condition. Now, when you're talking about area, though, if you're talking about apartment complexes, the school districts are going to be really important where the property is located. There's also going to be the crime rate is going to be very important because people don't want to spend time in places with tons of crime. But when you hear that old trope about real estate being location, 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 I don't like that saying because I don't think it's very informative. What I think they actually mean is traffic, traffic, traffic. If lots of people pass by a certain location every single day, that's going to be more desirable than a place that has fewer people going by. So, Peter, as far as you and your organization goes, like you mentioned that you rely on those blue chip sponsors, so they're probably going to have a more distinct buy box. But as far as you guys go, what's easier to say yes to and more difficult to say no to?
Well, we're for the most part on the sell side. So if you're looking at a property to acquire, there's a seller that has an issue, and we help you with the seller
Mm-hmm.
has it, or we could help you if you've got 20 doors and 2 of them aren't any good anymore and you want to get rid of them, we can potentially help with that. So geography is national.
Mm-hmm.
The size is typically larger deals, meaning the offerings that are out there are usually 25 million and up of syndication.
Mm-hmm.
Class is typically at the top, meaning Amazon warehouses, triple net leases, CVS stores, things like that. Because remember, it's the client that's looking for an exit from their building. They have a dog that they just want to get rid of, or it's gone up in value and now their net return is maybe 1% on fair market value. but they have no place to go for. So they use the DST as a midterm parking lot of 4 to 6 years.
Hmm.
Or if you're selling a property for 2 million and you find a replacement for 1.8, where do you park that 200 of boot?
Hmm.
Can
Hmm.
be that parking lot for the 200 and boot, and do some crazy sexy things with depreciation for which are beyond this call, but something in the future.
I love it. I love it. And that brings us to people. So each of us have our own unique skill sets, and all of us have the one issue because multifamily and commercial real estate is multifaceted, and it means that nobody's going to be all six sides of the die for any meaningful amount of time. So that means we're really eager to build new teams, give referrals to build new teams, but at the same time, because of our unique skill set, we're better off helping some people more than others. Me, because of the digital side of what I do, when somebody is just starting as a repositioner or as a local, I can only help them in a very limited amount. Whereas the sponsors and KPs, when they're the right way up, those are the guys who I can really help because they've already got a foundation figured out, and somebody like me can really make a disproportionately large difference. Whereas when you're first starting as a repositioner, as a local, you need grunts who can put in 80 to 120 hours a week, and that's not going to be me. So, Peter, it sounds like you mentioned that you're really interested in the sellers. So that means you'd also want sponsors and repositioners who are interested in this position, especially if they're nearing retirement age. But I don't want to put words in your mouth. Who's on the die as far as you're most motivated to meet more of?
Um, Actually, the people that I do the best with and help them increase their business, realtors, small CPAs, small attorneys, because they have clients, and this is where it would help for developers like yourself. Go talk to your realtor, your CPA, your attorney, because they have a whole book of clients that may or may not be happy with where their world is, and you're doing them a favor by helping them move it from point A to point B, and you're picking up their table scraps. Um, that's the piece in there that we find. And then at the same time, it's educating individuals about what their strategy is. Specifically, let's say Dan owns 20 doors, and 5 of those doors have extended their life cycle. He knows that they went from here, they're up to here. He's only making 1%, but that part of the country where he's at is tapped out. And we see this in Florida where people want to get out of Miami and go to Orlando. Well, the DST or just our consultative help can be informative. It doesn't have to end up in a product. First, I want to be able to tell you and educate you about, have you thought of this? Have you thought of that? Does that
Mhm.
make sense?
Yeah, yeah, absolutely. So that brings me to how to reach out. Me personally, I'm lucky because I have this super duper distinct last name that very few people have. So I'm easy to find, especially on LinkedIn, which is the social media platform where I spend most of my time. But if you have your phone handy, you can scan this QR code, and that goes to the FAQs page of 506 BME. 506 BME is the platform where I offer the IT services to maintain and help you collect your documentation of your substantive relations. Because if you get audited by the SEC, you have to show proof that you knew your investors' level of sophistication, appetite for risk, core competencies, financial situation in general. And you don't want to end up in a situation where you drop your laptop in a bathtub and then suddenly all that documentation is destroyed. So, Peter, as far as you go, social media, email, phone, website, what are the best ways to reach out?
Best way to reach me is I put my email up in the chat box, and then I'm also on LinkedIn.
Mm-hmm.
Um, I don't have that with me, so I failed that one of those rules of marketing the other direction. But um, no, LinkedIn is a big spot. I've got 20,000 plus followers, so there's a lot of people that I work with. Um, Email is great. And to go back to your point, we can't talk to you unless you're an accredited investor.
Mm-hmm. Yeah, full
Like you
stop.
said, those 3 letters of the alphabet, the S, the E, and the C will come back. And so if you don't have a certain salary, a certain net worth, the conversation's over. Doesn't matter. It's got to be over $1 million, not 850,000, not 925. So, but to reach out to me would be at my email address, peter@transformativenavigation.com, which is a mouthful, but the other place is www.dstsherpa.com. And the reason why it's a Sherpa, the Sherpa guides you through the mountains. It guides you to get to your destination. And it's just a fun little DBA that we use.
I love it. I love it. And that brings me to the last thing. It's actually not for you, Peter. It's another one of those public service announcements helping you through the mountains. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine like symptoms, I'm confident it's because of the downright hideous subscribe button that's right down there, and it's free to get rid of it. You just click on it. And full disclosure, I'm really biased. I want a lot of people to click on it because then YouTube will actually start to pay for these videos instead of me. I think that would be absolutely amazing. I should let you know what the trade-off is, though. As I said, there's no cost, but it does mean that my videos may show up on your list of suggestions. But quite frankly, you can go ahead and ignore those suggestions because, frankly, I really appreciate the fact that you spent this time with me. Just like Peter, I appreciate you joining me today. This has been great.
Would be happy to return or to dive into some of the more intricacies on it because depreciation's a wonderful word. Cost segregation is a wonderful word, and leverage deals are a wonderful word. And the reason I say that, here's the final tease. By investing in a heavily leveraged DST, $100,000 buy-in could net you in excess of $250,000 of depreciation in the first year.
Excellent, excellent, great.
So that doesn't get you excited or passionate. Buy one, get five.
Yeah, I love it. I love it. And we'll have to find out the intricacies of real estate professional status too, because I'm sure that would probably help. But that's it. So thanks for watching. Thanks for joining, Peter.
Thank you. Have a wonderful day.
Awesome. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.